Last year, at this time, we were in the midst of an economic and international health crisis resulting from COVID-19. We experienced record unemployment, declining asset values, declining rents, retail and hotel properties closing, increased vacancies, and supply chain disruptions. Now, with COVID-19 receding, we are confronted with a new crisis, a global war creating higher gas prices, escalating inflation rates, increased consumer prices, and now we're hearing the Federal Reserve is going to be projecting several additional interest rate hikes. What effect do these economic issues have on the commercial real estate industry? To find out, we have assembled 6 excellent speakers this morning. What are they seeing and what are they experiencing today? How are they coping with the current state of affairs? Our first speaker will be Jose Cruz from JLL. Jose will give us a broad overview of the commercial real estate market. Jose.
Thanks so much, Ron. Boy, that intro was a little bit of a downer. I'm not going to kid you. That was there was a lot of tough stuff in there. And look, we're definitely seeing some impact as to what's going on, but at the same time, there's a lot of positives happening as well. So what I wanted to do is just go over a few market trends. I have like 3 slides I just wanted to touch on, just so you can visually see some of the things I'm going to talk about. But I do see there's a lot of positive things going on. There's also some headwinds for sure, but I'll take them by product type just for a couple of minutes. Multi-housing, right? And we're seeing and you'll read it there, but the performance of the suburban markets all through COVID has been pretty positive. We saw occupancies increase. I think the last survey we took was 96%, which is strong even now for the winter months. And then also now the urban markets where we're seeing a lot more activity and lease trade outs, and I labeled here 15%, but we're seeing lease trade outs at 17 and 20% right now. And that's been really strong. And that's at Jersey City, Hoboken, Edgewater, West New York waterfront. So contrary to what we saw during COVID with the drop in occupancies and 2 months free, 3 months free, in one case, even 6 months free on a 26-month lease, today, that's not the case. And we're underwriting a property right now that had 2 months free in Jersey City up until about 2 months ago. And now we're down to no concessions in that asset. So, and as it relates to the waterfront, we hadn't seen a lot of activity since COVID started. So there hasn't been a sizable trade of multifamily on the waterfront since about January of 2020. I would say, given what we're seeing currently on the waterfront and the trades that are coming, there'll be multiple transactions. We're going to be launching 2 specifically large multifamily trades on the waterfront, which will be the first 2 since COVID. And we're expecting them to price in the 3s on a cap rate. So we'll keep everyone posted on that. But the activity from both a leasing and a rental increase basis have seen pretty significant increases since COVID. On the office side, the story's been a little tougher. Although for Class A office in New Jersey, we are seeing pricing north of $250 a foot. We just closed one at north of $300 a foot. And we're in the market with multiple deals, which I'm going to talk about in a second. But, that Class A office, which I think contrary to what kind of popular opinion is of how, destitute offices today, we are seeing demand for it. And we are seeing good action on Class A long-term credit leases. And we're seeing activity in office buildings that have rents below market. So overall, office isn't dead or even close, especially for the good stuff. The Class B kind of core plus value add product, that we are seeing pricing still challenging at sub $100 a foot. Obviously depends where you are in the state, but the office market, I'm actually fairly bullish office long term. So we're gonna hold on that. Industrial, I don't have to tell anybody kind of what's been going on there. That continues. The positive impact, the amount of capital that's been raised to invest in industrial. I mentioned here, we just closed a transaction at about $836 a foot in Newark, about a $65 million deal. And the rents in that building were $25 triple net. So very aggressive pricing on rents today. Rent growth, depending where you are, anywhere from 1% to 2% monthly, right? A month. So take that in. And then land prices. I mean, we're selling vacant industrial today in the Meadowlands at about $350 a foot. We're selling land on Long Island today for industrial development at about $230 a foot. So we've just seen real run-ups in those prices. So industrial, and it doesn't feel like there's any let up, you know, even given what's going on in the market right now. Industrial continues to power forward. Retail, we're pricing, and again, I'll label it best of the best. And by that, I mean kind of the top grocer in the market, great locations, and, you know, really great supporting cast of retail tenants in there. We're trading that in the 4 to 4.5 cap rate range right now. We have one deal, Whole Foods anchored center in the suburban New York area. We'll be closing in about 2 weeks. Long-term credit Whole Foods, that's pricing at a 3.9 cap. And that's pricing at $1,150 a foot. So very aggressive pricing for that. Now, that's a special, unique deal. More traditional grocers, we're pricing in the 5 to 5.25 range. Those are ShopRite's, Acme's, and so on. So really aggressive pricing for the core grocery type centers. And then non-grocery power centers, we're 6 to 6.5 on cap rates today. We just awarded one at about $70 million. And really good activity. There was a deep enough bench there. And that was a mix of some private funds and private buyers for that retail, for that non-grocery power center. And we're seeing more activity there. We're out with a large portfolio right now of a combination of grocer and non-grocer, very infill locations. That's going to price around a 5 cap today. So just to give you a sense of where retail is, and that's another product type that, you know, aside from multi and industrial, you know, has been lumped in with office and has been kind of deemed more challenging when, honestly, we're seeing a lot of groups kind of move towards retail because pricing of multifamilies in the 3s, pricing industrial, in some cases in the 2s and the 3s. So retail in the 4s and 5s is giving someone a return that, you know, again, with the right grocer and the right supporting cast, you can actually bank on. So that retail has been pricing pretty consistently now for the last year. Land, I'll tell you, I've been surprised at land pricing in the last 6 to 9 months. We're seeing land prices in suburban New Jersey now, again, very specific to location, but anywhere from 90 to 100,000 a door in the suburban markets. And we hadn't seen that in the past, right? That's something that is new now to the market. And that's a result of rising rents too. Even though we are seeing rising construction costs, and that's something that everyone factors in now for sure. But, you know, I put down here a return on cost metric of a 5.5. And, you know, historically, suburban New Jersey's been kind of in that 6, even 6.25 range. But given the drop in cap rates in a post-COVID world, the return on cost metrics for development has also come down. So we're pushing now a 5.5 with increased land pricing and increased rental growth. And look, so the trends here, for the most part, have been fairly positive. We're watching interest rates. I know that that's going to come up today as we have our panel discussion. But for now, the trends have been and continue to be fairly positive. And I'll talk on the next slide. We can go to the next slide, Leah. I'll talk a little bit about some of the deals we're working on, just to give you a sense. So I'll roll through these pretty quickly. 107 Morgan, land site, Jersey City. You know, that one we took out about 5 months ago, and we're closing that relatively soon. That deal is pricing aggressively today. Let's call it in that 90,000 a unit range, which for Jersey City is a great number. Historically, those prices have ranged pre-COVID from 90 to even 100,000 a door. Again, very dependent on the location, but very strong pricing and reaction to 107 Morgan. 75 and 95 Broad Street. These are vacant buildings in Carlstadt, or will be vacant buildings in Carlstadt. These are buildings that are pricing, again, as I mentioned, in industrial, super aggressive. 5 Giralda, this is a fully leased office building in New Jersey. This one's pricing in the, call it $150 million range. Term and credit. And although the tenant's not in occupancy, the cap rate will circa somewhere around a 7 cap for this deal. So this is in the market right now. Riello, without giving away the pricing, this is a 3.25 cap today, which very, very strong pricing for this deal. Needs capital probably in the $10 to $15 million range. A+ location, A+ quality asset, does need some upgrade to the units, but a 3.25 cap is aggressive, and that's closing shortly. And then the Haven, older product, multifamily, that cap rate's about a 3.75. So you can see the difference between the office cap rates, like I mentioned on 5 Giralda, the existing multifamily cap rates here. And I got a couple more just to mention on the next page, and then I'll turn it over back to Ron. But retail, see his Deptford Landing deal, Southern Jersey or South Jersey, the and larger center, 500,000, Walmart, Sam's Club, plus supporting cast. That was aggressively pursued. That deal is about 70 million, and that cap rate is pushing into the low 6s. So that priced really strong, and again, a deep bench of buyers. This 15 exchange closed last month, about 48 million, and we looked at that as a redevelopment as well of residential in Jersey City, given the location. Can't build in front of it, right? You got the water, and even if you got 400 units there at even 100 a door, which still wasn't worth as much as the office at 48 million. Plus, you have to buy out the tenants that were left. No cap rate on it because it was it's only 70% leased, but the per foot was 355, as I mentioned before, kind of pushing those per foot numbers above 300 or 300 plus. And the Union at Lyndhurst, we just closed this at 130 million. So this deal, we didn't even get to take bids. The demand was so strong back when we closed in October. So we took bids before our bid date at above the pricing we wanted. So really strong activity down the middle of the fairway, suburban, Avalon built multifamily in Lyndhurst. So on everyone's wish list. And the point of Fort Lee, just to bring it up, because kind of an infill location over by the GWB, about 142 million. And that activity was also pretty deep. So the demand, whether it was late last year, early this year, and going into the second quarter now, continues to hold. The big question we get now is, hey, rates are moving. What are you seeing? Is it impacting pricing? And the answer is it hasn't yet, right? And the reason I say it that way is because a lot of these buyers and a lot of the groups we're doing business with factored in a rate increase, right? It's no surprise the Fed's going to move rates, right? Then they've been forecasting that for a while now. The question is how much. So they have factored in higher rates in their underwriting and in their valuations. How much and for how long? So, and that's the question. That's deal specific, buyer specific. So no one knows the answer to that. But I think for now, we're still seeing positive trends, and we're hopeful that's going to continue. So anyway, I just wanted to give you kind of a quick overview of some of the things we've been working on and some of the trends we've been seeing. And Ron, I'll turn it back to you.
Okay, thank you very much, Jose. We'll now proceed in alphabetical order with our other panelists, and we'll have Gary from Carnegie Bank go first. Gary.
Thank you, Ron. And thank you, Jose. Your insights are always very helpful and always on target. I'm a senior vice president and director of CRE lending for Carnegie Bank. I've been in banking for around 30 years, starting the credit trading program back at Mid-Atlantic Bank back in the day. I actually started in CRE lending working for Mike Claisse, a fellow panelist. Mike is the reason I got into real estate way back then. Been a lender for most of my career, except for around 10 years where I handled financing for a real estate development firm, building around 1,200 units per year. Definitely realized the need to keep the money flowing to the clients for sure. I work for Carnegie Bank. Carnegie Bank is a $7 billion financial institution serving New York, New Jersey, Pennsylvania, Maryland, and Delaware. We're also in the process of expanding to Connecticut, Rhode Island, into the Virginia market as well. Our loan portfolio is around $4.5 billion. The CRE only portfolio is around $3.5 billion. We primarily work with owners, investors, and developers in providing financing for the construction and permanent loan projects within our market area. Have a team of 15 CRE lenders who handle loans in the various market sectors, and some that specialize strictly in construction projects as well. Our approval process is relatively straightforward. We have a committee process, meet weekly, and any loans that are over a certain threshold, our board meets weekly as well. Basically, our loan portfolio is broken down in mostly multifamily. We're pretty heavy multifamily lenders, around 75 to 80% multifamily, with the remainder being mixed use, warehouse, industrial, retail, and some office as well. Our typical loan products are perm loans, 5, 7, 10-year basis, pretty competitive rates. In the past year, we closed around $700 million in new perm loans. Last year, we entered the construction market a little more heavily after COVID. Been pretty active in providing construction financing for mainly mixed use and warehouse product. Kearny had picked up several large transactions at the tail end of COVID, when other banks sort of had curtailed their construction lending activities. We have about $300 million in our total construction portfolio at this time, around 35 individual loans. Typical loan size for our bank is around $3 to $50 million. Max is slightly lower for construction. Recent notable deals we've had, a $42 million refi of a anchored shopping center in Millville, a $35 million acquisition for an apartment building they own, a $30 million warehouse construction loan in South Jersey, and a large $35 million construction perm mortgage for a mixed-use project in Belleville. Basically, that we're pretty active, realizing that rates are starting to trend upward. We're still relatively active. Our pipeline is around $1.3 billion in total. That's about it for me.
Okay, thank you, Gary. Let's move to Michael over at Spencer Savings Bank. Can Michael hear us?
How's that?
Oh, much better.
That reminds me actually of my very first speech I ever gave in Vegas. I opened with like the greatest joke ever to nothing, and my mic was off. So I'm going to say it's a great joke. Maybe no one just laughed anyway, but I'm going to assume the mic was off. So I'm over here at Spencer. Now, Spencer is the largest mutually owned community bank in the state. We're about 100 years old. We just recently bought Mariners Bank out of Edgewater. So that brings us to about 26 branches. We're mostly in northern Jersey. We do have one down in Ewing. Headquarters at Elmwood Park, about 300 employees. We're about a $4 billion asset size bank. Our total lending assets are almost $3 billion, about 2.8. Income-wise, we've done very well, I guess. I'm still getting paid, so that's probably pretty good. Me personally, I've been at Spencer for about 4 years. My background, I've been in banking. I'm not going to tell you how long, even though I look really old on this. I was trying to blur me and not blur the background. That didn't help. So I've been, my main background is money center bank. So I come out of Bank of New York, mainly Bank of America, though I did really start in Atlantic and NatWest, and pretty much every one of those banks I was with Gary Brozowski. So this is, at least we're finally on a computer screen back together. And my background is really more non-balance sheet, so construction, tax credit, equity, things like that. Now, I'm the director of real estate over here at Spencer. Our real estate portfolio is bordering right about $2 billion. Everything we do is in-house. We have about 20 employees. We all underwriting portfolio, closing, and our loan officers are all done here. And we, very similar to other banks, after a certain level of my approval, then we go to credit committee, which is a once a week type thing. Now, actually, contrary to my career, Spencer is really more of a balance sheet lending bank. So what we do is pretty much mostly perm lending and construction, which then converts to perm. Our markets are New York, New Jersey, obviously heavy in Jersey, but we've actually morphed from probably about 4 or 5 years ago. We were about 90% New Jersey, 10% others. We're probably about only we're 60% Jersey, and the rest is primarily in the boroughs. Brooklyn, we have a heavy concentration, especially of market rate apartments. And we do some Pennsylvania, mainly Philly, and a little Connecticut. Our typical deal size goes from probably 2 million to 25 million. Sweet spot's probably 3 to 10, but we do larger and smaller, and we certainly like to participate. And I've talked to probably every lender on this about doing deals together. Typical loan types, we're multifamily, and again, we're big multifamily. Our portfolio is probably about 60% and growing in that. And I'll talk later about that, especially during COVID, where we saw better opportunity, obviously. A lot of industrial, retail, office, though primarily medical office. And we do purchases, cash out, refi, and certain limitations. We're really trying to build our construction portfolio, which is kind of a push right now, I'd have to say, and that's construction of multifamily. Really should talk about like what's going on lately. And the last time we spoke, we were everything was kind of rosy in 2019, and we all had a pretty nice, robust pipeline. And then I was feeling kind of cocky. And then March of 2020 hit, and then it all hell broke loose. So but with some exception, we did kind of hold firm. We've been a pretty conservative bank all along. We have very minimal delinquency. So we were able to continue lending with some adjustments. And in 2020, we finished with about 400 million in loans, which was, we're a $2 billion bank in real estate. So that wasn't a bad year. In 2021, actually, we didn't stop, and we did some adjustments again to underwrite, and we can speak about that, as we all probably did. But we closed about $700 million in commercial real estate financing. Now, I get to do a paid for advertisement. This made Spencer the highest growth rate, the bank with the highest loan growth rate in 2021, according to the 2021 New Jersey Bank Performance Report. Very, very important report. So you guys remember that. So that's my advertisement for Spencer. The pandemic, and Jose, thanks. We knew it changed it. Changed the world. It changed commercial real estate. And now we have the Ukraine war. We have inflation. We have job market, rising rates. So like things weren't easy enough. So now we have some more stuff we have to consider when we're looking at future markets and where we're looking. But the bottom line is we had to adjust in the past, and we have to adjust now. In the past, to get through COVID, we changed our underwriting metrics, some of our standards. We used some reserve accounts to kind of get us through the tough times. And I'm sure all the banks did that as well. I'm pretty sure we were the first one to do it, but you guys all copied afterwards. I'm trying to get Steve to smile down there. He's a little too serious. But we're still active. And again, we've modified some approaches. Post-COVID, we've eased up on some of the metrics we're using. We've lowered some of those vacancy rates and some of the tight debt service coverages, as well as the cap rates. So we are moving along. Now, we've always been a strong multifamily. We're going to continue to be strong multifamily. We do all recognize the world of e-commerce. So flex spaces, as people have talked about and will talk about, that's still strong. We see it being strong. Office has never really been a predominant asset class for Spencer, but we do office, and we do recognize that full remotes, I don't think we see full remote being something of the future. So there is appetite for it, and as all loans, it's a case-by-case basis, but it never was really a strong part of our portfolio. Even though we did just close about a $7 million fully office building in Fort Lee. Medical office is always strong with us. It's going to continue to be strong. Retail is a little bit of an odd egg. prior to COVID, large box was on the downswing anyway. And our bread and butter, besides multifamily, was the community retail centers. And as we all know, they took a huge hit when they had to shut down. So, and thankfully say we had no losses from COVID, but it was a tough go for a while there. But we're seeing, there's some hiccups now, but we are seeing some comeback. And frankly, if you're a business and you're still in business now, then you survived this terrible market. So that's a good credit strength for a tenant. You're still there. So we are still looking at retail. And then, as I mentioned earlier, our greatest growth is multifamily construction. Not as much for sale, more rental construction. And based on what we're seeing, we feel the delays that we saw from the past delays, the pricing, the jobs that were in the past, that's kind of behind us. So if you're pricing a deal today, you're on market. You should be on point. And we are still talking a couple of years out as the market gets better for your lease up. So we're cognizant of the workforce, and I hate using the word supply chain, but we always have to be cognizant of that, no matter what we do. The bottom line is we all of us have to figure out what to do and what we're going to do going forward. We have to protect the banks, but still stay within, and help our communities. When we went through COVID, Spencer, we just really saw the responsibility to really keep lending. So we held true to what we were trying to do. And then coming out, there's I think we all see a lot of opportunity, even though, as we'll talk, the interest rates are going to make things slightly tough for all of us. But that's good. Thanks for the time to talk. And hopefully I can get Steve to smile at one of these conferences.
Thank you, Michael. We'll move on to Steve at Lakeland Bank.
And Michael, thanks for the shout out a couple times. All right, I appreciate it. So Steve Novak, I'm one of the executive vice presidents with Lakeland Bank. A little bit of general history of the bank. Started in 1969, so we're 53 years old at this point. We are slightly over 10 billion in assets, so we're the largest bank currently on the fall. That growth has happened both organically and through acquisition, including our most recent acquisition, the First Constitution, where they joined our family a couple months ago. So we're pleased to have them with us, and then expands our footprint in the New Jersey market. Currently, we have the legal lending limit, or at 12/31, we have a legal lending limit of $120 million. That was pre-First Constitution, so that number is going to adjust upward when we reset the legal lending limit at the end of the first quarter. So we've got very strong capacity. Internal limits, I mean, most banks our size set the internal limit that is, quite often around 50% mark from where our legal limit is. So we've generally been in kind of the $60-70 million range for any one customer. And then we further control the concentration risk by limiting the amount that we do on a single asset. So on a stabilized basis, that's typically been running in the $30-35 million range. On development, transitional assets, that's kind of been in the $20-25 million. From a geographic region standpoint, I really classify us as a right-sized regional. We're New York Metro, Philly Metro Bank. So all of New Jersey, we have Hudson Valley, 5 boroughs, although we don't do a ton of stuff in the 5 boroughs. Eastern PA, Northern Delaware, into Connecticut, some stuff in Long Island. But generally, that's our primary market. We do follow customers outside of market on particular assets. So we do provide that level of flexibility to our clients if they're looking to acquire something, outside of the New York metro market. LakelandBank.com, you can find us there. We're want to check out some more about me or bank. You can look at it there. We've received some recent recognitions, Best in State Bank by Forbes, American Bankers, Best Banks to Work For, 5-star rating by Bauer, and one of New Jersey's 50 fastest growing companies over the past couple of years. We're a full service bank, so we do commercial real estate. We're heavy into commercial real estate, but we have a very strong C&I book that also includes a healthcare division, asset-based lending division, equipment finance, life insurance financing. But CRE, as many of the, especially the banks that are on this call, that's pretty much the concentration for these banks. Similar to what Michael was saying, they have a heavy concentration of multifamily. That is also our highest concentration, but we're pretty well diversified through all asset classes. So, there's nothing that we don't look at. And obviously we assess each transaction depending on the merits of that deal. We do both stabilized and development loans, transitional assets. So we do a lot of construction, we're very good at it. Helping people do bridge financing to acquire stable transitional assets is something that we get a lot of traction with more. We have a very good, strong credit quality very highly rated by our regulators. So we do a lot of. We also make sure we're doing it the right way. The last 2 years have been without a doubt, and as Michael said, things have really humming along. Prior to the pandemic. Pandemic hit, things kind of breaked up a little bit, and prior to that, we had a pretty long recovery since kind of the 08-09 timeframe. What do we see as the impact of the pandemic? Office market, pretty much everybody turned to remote, and what does the future hold on that? We're really not sure at this point. I can tell you Lakeland Bank is converted to a hybrid model. So we pretty much have people on a rotating basis, and we'll see how long that lasts. The current workforce, especially the millennials, they like the idea of being able to work remote. So if you want to attract talent, and we've all dealt with challenges in attracting talent, you've got to have some flexibility in how you develop your workforce. On the retail side, that's the area that we saw most impact during the beginning of COVID. And we did $1 billion in deferrals, helping out our customers, which we're now basically down to nothing on the deferrals. Anybody that needed a little bit of extra help, there was something that the government came out with called the CARES Act. So we helped support our customers to make sure that they were okay. And we worked well with them and didn't put them into trouble. But we are seeing, retail locations with tenants that are shuttering some of their locations, and we're obviously keeping an eye. We know that everybody bailed out of heavy concentration urban multifamily markets. So if you tried to find a house to rent at the Jersey Shore right after the pandemic hit, good luck. That is coming back. So the trends are looking very positive. I think Jose was talking about, that, concessions are basically not happening at this point in Jersey City, for example, but you're seeing very strong recovery in the 5 boroughs also. New Jersey, other multifamily, not urban, remain very strong during the market. There were smaller assets that probably need a little bit of help if there were workforce housing and there's challenges with tenants being able to pay. But again, we worked through that with them, and they've come back strong. We are not huge hospitality ones. We have a decent book, and especially with First Constitution, because they were more active in that market. And hospitality's coming back nicely. Obviously, we know it got hit at the beginning, but we're pleased to see the trends that we're seeing now. So when the pandemic hit, the rates dropped out in March and stayed there. And there was a ton of liquidity, there still is a ton of liquidity in the market. So chasing a lot of deals. So between the low rate environment and the liquidity, it's been a very active market. The issues now, what do we lose sleep over at the present time is, inflation. Can it get under control? Is the Fed behind the 8 ball on that? What are we going to see? How's that going to impact the market? We do see our customers having some supply chain problems. We also know that we're seeing, on development loans, and I'm sure Michael is doing the same thing, keeping an eye on this, is, what's happening to the plus and is there budget integrity with the development projects. Folks are holding up until pricing comes back in line. They're doing okay, but we have to see how deep the cuts go. And if inflation stays in place. We had the first rate bump last week, obviously, as you know, with the Fed. So they went up 25 basis points. There's a big debate over what they're going to do for the long run being over the next 2 years. I would tell you that, I think that 150 basis points is probably a reasonable assumption. And we're going to have to see how that impacts the different markets, both on the commercial side, the residential side. It's obviously going to affect mortgage rates. The interesting part is that the long end came up with, before the Fed moved. So it was already getting built in to the market. So, we're up 100 basis points since the end of the year when you're looking at the long end of the curve. The problem is, especially for banks, the challenges are that banks operate better when there's a steepness to the yield curve. And the yield curve is extremely flat from 2 to 10 years, which is where most of the pricing was done. In fact, this morning, I think the 5 to 10 was inverted. That becomes a challenge on how to handle the market. I'll talk a little bit about that. But the short end is going to start coming up. And if we don't see a big bump on the long end, it's going to end up, further flattening the curve, which can get interesting. But therefore, we need to be out there trying to figure out ways to not only help our customers manage the interest rate risk, but also how the banks are going to manage the interest rate risk. So we have tools that we've created. We are a swap house. We can do swaps. We can do forwards. So people that are in development right now, we put forwards in place so that they've got assurances on their interest rate as they stabilize their assets. We can do collars. So on floating rate products, they know where their risks are or that they're limited. And we do it for ourselves too. We have to continue to look at whether or not we're going to do balance sheet deals or if we're going to hedge our positions through the derivative market by doing swaps with our customers. We are a big balance sheet lender, but it's obviously become a little bit more of a challenge over the past 3 months as the long end of the market has come up. And it's going to take a little while for the rest of the market to follow. Impact on cap rates, there's some concern there. As rates come up, inevitably, there's going to be some upward pressure on cap rates. And as you know, cap rates go up, valuations go down. So we have to keep an eye on what's happening with the valuations of our assets that we hold as collateral. And customers need to look at that also. From a geopolitical standpoint, that's a big unknown. We don't know what's going to be happening. It seems like the market has been able to manage through the process at this point. But if there's further invasion, especially into NATO countries, that could be a little bit of an issue. So we have to keep an eye on it. So we've been very active trying to figure out how to properly manage our customers and help them in this market. And we're going to continue to do that. And I appreciate you taking the time and listening to some of the things that are going on. I'm back.
Okay, sorry. Thank you, Steve. Let's jump to Randy, who is our sole attorney on the panel. Randy.
Thank you. So I'm Randi Schillinger, and I have been doing financing for probably 30 some odd years. And I've been handling usually the bank side, although I do both the bank and the borrower side. So in my couple of minutes that I have to talk, and as being the only lawyer on the panel, I thought I would start with two recent legal tidbits that I think will be of interest to the real estate community. I also wanted to spend some time just talking about the whole redevelopment process from the lender and borrower side in New Jersey. I think that that is now the rage, or has been the rage for the past number of years. The first thing I really wanted to just do as my legal tidbit is President Biden signed on March 15, 2022, the federal LIBOR discontinuance law. I think everybody knows that LIBOR is basically retiring as of 2023. And the purpose of the bill basically is to provide for the transition of certain contracts. There are a number of contracts where you use LIBOR as the interest rate, but they have no replacement rate in there. So the bill is going to establish a clear, uniform process to be used nationwide for replacing LIBOR. What's happened is you've had states, New York passed the law, Alabama passed the law, basically individually trying to deal with LIBOR if there's no replacement rate. What this law is intending to do is to make it nationwide. And what it will basically do is it's going to prevent litigation. It's going to allow for existing contracts to operate according to their terms if they retain a rate. If not, then starting on the first London banking day after June 30th, 2023, the rate that's going to be set by the Board of Governors is going to become the rate. And it's going to supersede all the state laws. That's my first tidbit. My second one is on December 8th, 2021, the Federal Crimes Enforcement Network, FinCEN, proposed rulemaking. It's proposed, and they are seeking to solicit public comment on a new rule designed to tighten reporting requirements, which I think now, considering all the sanctions that are in place, are probably even going to be more important. Now, this is a proposed rule, and it applies to specific persons involved in real estate transactions, and it's going to require the collection of reporting. But what's interesting, it's for non-finance transactions. You've had that for residential through title companies. That has been in place, but now this proposed rule is non-finance transactions for commercial and residential. And it's going to go to attorneys, law firms, real estate agents, and others who are going to have to report. The rule is proposed. They are looking for comments on it. And if you're interested in what commenting, I can send you where it is in the Federal Register. The consideration is it's going to be nationwide, and it's both for commercial and residential transactions. Those were my two legal tidbits. I wanted to transition then just to talk a little bit about redevelopment projects from both a lender's and a borrower's perspective, and more the legal aspects of it, since I'm the lawyer on the panel. I think everyone agrees that, with respect to construction lending, redevelopment projects have really been the rage over the past 10 years in New Jersey. They, however, really do involve a little different approach than the standard ordinary construction lending scenario. There are two main documents that a borrower and a lender needs to worry about or be concerned with. The Redevelopment Agreement, which is the agreement between the redeveloper and the municipality, and the long-term tax exemption. 99% of redevelopment projects utilize a long-term tax exemption under a financial agreement. And from a lender's perspective and a borrower's perspective, there's certain things we need to understand about this. The redevelopment agreement, that's the agreement. That's the understanding between the redeveloper and the municipality or the agency that's running the redevelopment. What do you need to look for? Does it have the redeveloper? Is it right name in it? What's the project? The project in the redevelopment agreement should be the project that's in your commitment letter. If it's not, there's going to be a divergence there and there's going to be a concern. Same thing from the borrower's side. Is that the project that was approved by the site plan? The time periods need to be looked at. Redevelopment agreements have benchmarks in them. From the borrower's side, you got to make sure you can meet those benchmarks. From the lender's side, we want to make sure that what your commitment letter says matches those benchmarks. The term of the loan. Redevelopment agreements generally say you're allowed to have a first mortgage with a certain percentage of a lien. You have to make sure your mortgage matches that. The most important provision in the redevelopment agreement, in my opinion, from the lender side and also from the borrower's side, is what does it say about your rights and remedies? I've read in my career, I don't know, hundreds of redevelopment agreements. Some of them are the most comprehensive. They cover every single default provision necessary. Some of them say literally almost nothing. So you need to make sure from a lender side that you've got the right of foreclosure, deed in lieu, and it allows you to take it in an affiliate. I don't know any bank today that takes any foreclosure in their own name from liability purposes. You also want to provide that the mortgagee has the right to complete the project. And most important, as I said, you need notices of default. You want to make sure it gives you the right of foreclosure. And from the borrower's perspective, it really makes sense to negotiate these provisions at the outset of your redevelopment agreement, not subsequent when you suddenly now have a loan, because it'll just streamline the process. So, as lenders counsel, what I have found is prudent practice, and I'm not alone in this, is when you get the redevelopment agreement, you're gonna send out an estoppel certificate to the township. I would really suggest that is done immediately, because that is a time-consuming process. The township normally negotiates it, has to send it to their attorney. What should this estoppel say? You want a rep to know that agreement's in full force and effect. You want to know this is the complete agreement. You want to know there are no defaults. You want to know no rights have been assigned. You want to know that your specific mortgage loan is approved. And like I said, you want to look very carefully at those rights and remedies. And if it doesn't include the rights and remedies, you want to put it in that certificate so that you get the benefit of it. The second most important document is the long-term tax exemption financial agreement. And I think everybody agrees that all redevelopment projects, or 98% of them today, I think I've done one without one, go for the long-term tax exemption, which allows, in lieu of taxes, you pay annual service charges. For a redeveloper to obtain the benefit of this, they have to be an urban renewal entity. This has very specific requirements that have to be in your certificate of formation and are required to be approved by the DCA. Lender and a borrower needs to make sure they understand the limitations of an urban renewal entity. From the lender side, when you're reviewing the transaction, from the borrower's side, when you're just doing your transaction. They only allow limited dividends, limited net profits. If the net profit exceeds the benchmark that's listed in there, they have to pay the municipality the difference. They can only own the project. If there's a transfer of more than 10% of the ownership, it requires the township, the municipality's approval. The financial agreement, that's the key document for the tax exemption. And often that may make or break whether the project works financially. From the lender's side, the concerns that I have on a redevelopment agreement, I have the same on a financial agreement. Full force and effect, no defaults, no assigned rights, provide for notice. The difference, however, is, and many people don't know this, there is a specific statute in New Jersey that gives the holder of a mortgage rights in financial agreements. And for anyone who cares, it's NJSA 5517-1. And I always want to make sure that my financial agreement and my estoppel provision says I get the benefit of those rights. And it basically says that any financial agreement made by a governmental body for a redevelopment agreement, you have the benefits of foreclosure, and you're not deed in lieu, and you're not subject to all the requirements under the financial agreement. It allows the project basically to go to foreclosure, and it's not going to be applicable to the holder of a mortgage. It gives notice of default to the holder, and it lists a whole host of remedies that a lender has. They can enter into possession, They can receive a deed in lieu. They can sue on the note. It gives you the litany of lists of what a lender can do. Whether it applies to a redevelopment agreement is up in the air, but from a lender's perspective, from a legal side, it makes sense to put it into both if you can. And it is liberally construed. So while what I have seen, almost every construction project, short of maybe 2 or 3 of them, have gone through the redevelopment route, considering that there we need to look at that there are other provisions that need to go when you're looking at a construction project from a redevelopment than the standard construction project. Going forward, I still see a pretty strong redevelopment going on out there. That's what I've seen in construction projects. I haven't seen very much of a slowdown in it. We'll see going forward as the rates rise, if that's going to be a slowdown. That's my speech. Thank you.
All right. Thank you very much, Randy. Before we get to Ken, I want to just remind our attendees that if they have any questions for any of our panelists, they should put them in the chat. We will get to as many as we can as soon as Ken finishes his comments. And with that, Ken, you're on.
Thanks, Ron. My name is Ken Wood. I'm a managing director for Verus. We are a nationwide direct lender. We offer commercial real estate bridge loan for transitional and value add assets, as well as providing financing solutions on a perm basis for single family rental portfolios. We have about 3 programs, and I'm going to touch briefly on each one. Our first one is a balance sheet short-term bridge loan. We do deals at as low as $3 million and up to $40 million. Term is 12 to 24 months with extensions. We charge a 1% origination fee. We're interest only. We have no prepayment penalties. On a loan to value, we can go up to 80% for multifamily and industrial. On other assets, which include office, retail, mixed use, self-storage, manufactured housing, and hospitality, we can go as high as 70% on those. We have what's called a heavy lift and a light lift transition for this. Light lift meaning the owner, the borrower is buying the property, and there's just some renovation that has to be done that is 20% of the loan amount. Those rates probably are in the low 6s at this point. We also have a heavy lift program. This would be for, say, a vacant building or a property that's 20% occupied. Again, we will do the renovation. We'll hold back for TI and LC for tenants, and rates on those are probably in the high to low 7s. We have an intermediate bridge program, and this is a securitized product. Deals are 5 to 50 million. They're 3 years plus 2 one-year extensions. Again, a 1% origination fee. LTV again is 80% for multi and industrial and 70% for all other types. A prepayment penalty is on this one. It's 18 months. Rates are probably, it's tough to say right now because there's definitely some transition going on in the market. But I would say on multis, we're probably in the mid to high 4s. Same with industrial. On other products, we're probably in the low to mid 5s. We are now pricing over SOFR. We've moved away from LIBOR. So that's how we'll be pricing going forward. And again, this is a securitized product, so we need certain debt yield thresholds and debt service coverage. Our third product is the SFR. This is our single family rental portfolios. This is a permanent loan product. Loans can be as low as 500,000, go to 15 million. Terms are 5, 7, and 10 years. You need a minimum of 3 properties in this product. We can do up to 75% loan to value. It is also a non-recourse product. Rates are probably again, starting in the low 4s. And the property types include single family deals, 2 to 4 unit properties, warrantable condos, PUD, townhomes, and then we can actually put in a multifamily up to 20 units. So it's a unique property, and a lot of these borrowers, have collected 50, 100 of these properties, have been working with local banks, and the banks are like, hey, we have too much with you guys. And that's how this program started. And it's an interesting product, really. And again, that is also a securitized product. I'd say the biggest concern my credit committee has is how are we going to get taken out, and where are we going to stress rates based on the yield curve going up? So that's the biggest challenge that we're facing is, do we stress perm loans at 200 over, 300 over? It's tough right now, but that's our biggest challenge. And the biggest thing we're looking for when we're doing a value add product is also, how's the market? Is the borrower giving us achievable rents that he's projecting? That's all key to these programs. And again, we're looking to get the product stabilized and then get out. Hence, that's why we're a bridge program. And we've been very active. We're seeing a lot of transactions. Last year, we did just around 500 million. And, we're looking to do 800-900 million this year. So you can go on veruscref.com to find out any more information, and my contact information is out there. So that's what I got, Ron.
Okay, thank you very much, Ken. Before we get to the registrants Q&A, let me throw out 1 or 2 questions coming from some of the commentary from our panelists. So my first question is for Jose. I always like to ask Jose a question. Steve, as well as some of the other lenders, have acknowledged that the Federal Reserve is going to raise rates, which will have an effect on cap rates, which will inversely affect valuations. My question is, do you sense or do you see that potential valuation issue in your market studies?
So I think in the short term, like I said, I think a lot of the investors and a lot of groups underwriting have factored in interest rate increases, right? So we haven't seen yet any significant change in pricing. So the question is, over time, with rates rising, which they definitely will, right? I think there's a couple of questions. 1, what happens to spreads? I think 2, what happens to NOIs, right? If we're in an inflationary environment, you're going to see rents move up. So if you see rents move up, NOIs are going to move up. So even if cap rates move, they come down, and look at whether they come down 25 basis points, 50 basis points. If you see a comparable increase in the NOI, the pricing doesn't necessarily change. I think for now, the consensus is the amount of equity out there, right, so far seems to be offsetting. And again, along with the budgeting of potential interest rate rising, seems to be offsetting any potential changes in price. Long term, I don't think anybody truly knows, but we are forecasting significant increases in NOI, especially think about multifamily, right? You're resetting those rates every year, right? And we're seeing, as I mentioned, those lease trade outs, a 15% increase in some cases, a 20% increase in the rents. So will that offset? No one knows the exact math, right? But so far, we're forecasting that increase. I mentioned before, increases in industrial rents, right? At 1 to 2% a month. Some markets even more than that. So we're seeing those NOIs rise and continue to rise. So I think we're gonna have to see how it plays out. Do I anticipate rates increasing? Yeah, of course, right? But what happens to cap rates, given the equity out there and given the rise in NOIs, we'll see.
Okay, for Randy, as lenders counsel, have you seen any out of the ordinary loan transactions or loan structurings, and how did you address it?
Interesting. One comes to mind. So I received a commitment letter and it basically looked very standard, small mixed use building, straight loan. It was an acquisition. So I took a look at the contract, and the contract basically said the cell tower is not part of the transaction. And it got my interest perked. Talked to borrowers counsel, and what I have found is, and this obviously is more prevalent than I guess I've seen too much of. You have a building that has a cell tower lease on it. There is a market out there for just the cell tower leases. And there's companies that buy the cell tower leases from the property owner. Usually it's based upon a certain amount of months of cell tower rent. They then go to sell the building, but they are not selling the cell tower lease area. So they've really broken up the building. And when I'm looking at why you do this, it's done this because the sum of the parts equals much more than the whole. The cell tower lease is X price, and then the rest of the building is Y price, which is more than when you sell it together, because when you sell with the cell tower lease on it, most people look at the cell tower leases and say, they're cancelable at will, which they are. And they don't put a lot of faith into, and when they calculate it into cash flow. But from a lender's side, you have to be a little careful on this. So what are we looking at? You got a cell tower lease agreement. Current property owner doesn't own it. A third-party company owns it. They've assigned, the owner of the building has assigned that lease to this third-party company. He's also given them an easement agreement. He's given them an easement agreement to where the cell tower is, and for all the utilities and cables and everything. From a lender's side of this, what are you concerned about? Well, the cell tower company wants a non-disturbance agreement. If your mortgage is ahead of it, they don't want to be kicked out. If your mortgage is behind it, you're going to want a subordination non-disturbance agreement to make sure that if that cell tower company easement, not lease now, default, you want to get them out. But from the lender side, and even from the borrower side, you need to be aware that notwithstanding, you're not getting the rent payments as the lender or as the new owner of the property. They are going to a third-party company. However, so when you foreclose, you got to be concerned. It's subject to the cell tower lease. You also, what's interesting is when you read these agreements, they often say the current owner is still responsible for services, for insurance, for electric. They usually have reimbursements, but you have to make sure that the reimbursements go either to the new owner or the mortgagee, depending on how they are structured. So it's been an interesting new development that it's not as new as I've seen, but it's been around. But I'm beginning to see more and more of them now, where they've more or less broken up the building between the cell tower lease. And there are substantial companies out there that this is all they do. They buy cell tower leases.
Randy, while we have you on the mic, Howard in our audience is asking what the NJSA number is with regard to the financial agreements that you referenced.
What do you mean by the NJ number? Oh, the statute. I'm sorry.
Yeah.
So it is, hold on, I'll tell you. It is NJSA 55:17-1 et sec.
Okay, hopefully that answered Howard's question. To our 4 lenders, what underwriting issue have you implemented today that you didn't have last year as a result of trying to operate in today's environment? And any of the lenders could respond to that.
Rate stressing.
Who is that? Ken?
Steve.
Steve, can you go into a little more detail about how that works?
So the bank didn't, and we always did a little bit of stressing, all along. That's become a bigger issue, especially if we're talking about development loans, as to what we will potentially be looking at when we come out of construction. And that's why when I was speaking earlier, I was commenting about mechanisms that we can help the developer be able to protect their risk from that standpoint. Also helps us to underwrite to a deal, knowing that we have a level of confidence as to where the rate's going to be. So, for example, we did a number of development deals that had forward starting swaps. So they start construction today, construction term runs for 24 months. We put them into a forward starting swap today. And, for a while there, pre-pandemic, the bump up in the rate for the forward was very little. It did spread during the pandemic, but it's still an effective tool. So that, let's say I was going to do a deal today, let's say, use a flat rate 4%, that it checks out on a swap calculation. If I've got a 20 basis point step up on a 24-month forward, then I could underwrite and do a forward starting swap 2 years from now at 4.2, 4.25. And that way the developer knows that they've locked in basically the rate. So as long as we're not concerned about the execution risk, and then we can get to the finish line, that gives some protection not only to the borrower but also to the bank. So it's a more active dialogue, that we're having, obviously, in a rising rate environment, and we have to stress the loans. We're not going to, hedge it at all. Listen, I just got off loan committee before I got on this call, and we were stressing a line of credit secured by real estate, 2-year term. What if rates instead of 4% are on a floating basis are now 5 to 5.5? What does that still look like? Are we still okay? So that's a more active discussion now, both internally and with our customers. I'm sure the fellow bankers are probably doing the same thing.
Yeah, I'm in agreement. Yeah, obviously that we definitely had to stress the rates, especially on the floating rates. We also, if we were mid-construction or starting construction, we actually extended the term, assuming there could be delays in approvals and various things like that. So as opposed to continually going back and doing extensions, we simply we gave what would normally be an 18-month, we'd give it a 24 or even a 36-month term just to give some leeway. And again, and then also increase in interest reserves and so on. But we did, and the other thing we really did, and we're still doing, but we've cut back, is we are heavily stressing vacancy rates and collections. That's actually two separate things, even though we always talk about it together. Even today, if you have a 3% vacancy rate in Jersey City, let's say for a multifamily, we're still using probably 5 and 6%. And if it's a 5 or a 6 in other towns, we're probably still closer to 10, which is, it is kind of lowering our proceeds, which kind of almost goes to what Jose was talking about. And someone had asked a question about cap rates. I kind of see it as the proceeds going down, but Jose's answer was there's more equity in the market, meaning that for right now, I think that proceeds might be a little lower on some of the deals. Not that we're particularly worried about them going forward. And the other thing we ask more now that I don't think we really asked in the past. We always looked at leases, as Randi knows, because she gets all of them. But now we ask collections. I think in the past, we kind of got, if you have a lease and you show us an income and expense statement on, say, a smaller deal, that was usually good enough. Now we always ask, what's your collection rate for this property and your portfolio, not just what is your on paper income. That was a long answer to a short question, sorry.
Any of the other ones want to comment?
For me, it's extremely important, again, being in the bridge lending area. where rate's going to be in, 2 or 3 years on a perm basis. And, so we are highly stressing more than we did a year ago. And I think going forward on new deals, it's going to affect proceeds, and we're going to be cutting what the borrower's looking for.
Interestingly, Ken's response and Michael's response are hitting on a question we are getting from Renee in our audience, which is basically, as interest rates start to rise, wouldn't that typically mean that your debt service coverage ratio is going to go down? And if so, are you adjusting to get this deal done by lowering loan proceeds?
Again, we're on our balance sheet program. We don't really worry about debt service coverage. If we have to, we'll set up an interest reserve and solve for it. So again, for us, it's more about how are we going to get taken out in 2 or 3 years. In our intermediate program, that is essential. We're looking at debt service coverage and debt yield. So yes, I would say loan proceeds are going to be cut on new transactions going forward.
How about from our traditional lenders?
Yes.
Yeah, I'll have to echo that as well. It's, definitely we need a cut in proceeds. Appraisers are, when they're doing their reviews and everything else, they're bumping up the expenses as well. So it's definitely going to affect. Just have to manage expectations going forward.
Great answer.
Randy, legal fees are always a hot topic in loan transactions. My question is, are you still seeing concerns about legal fees, either from the lender's point of view or from the borrower's point of view?
The answer is yes, from both sides. That is always a point of contention. And from the lawyer's side of it, it's a difficult scenario because your client as the lender is the customer who we're making a loan to, but we are representing the bank to protect them. So there's always that internal pull. But yes, we still see, when every comment for any commitment letter comes down, we've never seen a legal fee that high. Can you reduce it? So we still see that on both the borrower and the lender. Today, and as you go on, there's more and more review and of documentation and what needs to get looked at. And unfortunately, that increases the fees, especially in certain types of projects. But yeah, we definitely still see a pull from lenders and borrowers fees, but we come to an accommodation.
Yeah, I think on a similar vein, from the brokerage perspective on brokerage fees, I think the general consensus is they're too low, which is kind of odd. It doesn't, we get it a lot. Can we increase your fee? Can we increase your fee? So anyway, I'm just kidding. But yeah, we're actually not seeing as much pushback. So.
I have never heard anyone in this business say that legal fees are too low. That is a first. To our lenders, as we head into 2022, what is your biggest concern or your biggest fear?
I go first. Right now, I think our concern right now is figuring out where the interest rates are going and how it's going to affect our debt service. But there's a million concerns right now. I think this moment in time, that's it.
Yeah, right now, the issue is kind of the playing field, right? And there's a lot of liquidity in the market, as Jose previously said. So there's liquidity in the market chasing the real estate transactions with Jose's clients. And there's a lot of liquidity in capital markets, which Jose's counterpart, my client, would be his client, right? So, so the challenges we have as a balance sheet lender is that competition and how's that all shaking out? Because as Mike said, there is some, there is concern as to where rates are going. That's why, there's an added level of stress. It is affecting proceeds as to what number we can get to and feel comfortable assuming that there's going to be stress in interest rates and stress potentially on cap rates. I mean, I don't disagree with Jose in the fact that, I think we've obviously seen growth on the top line. But is there an end to that at some point? And at some point, will interest rate carry, debt service carry outstrip then the growth that's happening? Because if the NOI can't keep up sufficiently, again, it's gonna affect how we underwrite the person. It's a challenge. We haven't had this market in a long time. It makes a lot of us scratch our heads as to handle difficult transactions.
I think.
Oh, go ahead. Go ahead.
I think, as far as rates, I mean, I think, to put a positive spin on this, even though we're in a rising rate environment, for the lenders that have been around for a while, I mean, these, have been the lowest rates ever in history on the commercial real estate side. And I remember doing deals at 6-7% interest rates in the past. I mean, it's going to affect everything. I think managing expectations of the client and also, it's going to be a learning process with how the appraisers deal with their evaluation issues with expenses and everything else. But there's always opportunity to do good deals. May require a little bit more on the equity side to come in because proceeds will be affected either way, whether on the expense side due to expenses increase or higher interest costs. So, but still, it's these rates are still relatively low, and but everybody has to manage their expectations going forward. Some people who are doing deals now have never seen a rising rate environment like this, and I think everybody just has to hope for the best as managing your expectations.
Yeah, Ron. One of the things that people were doing was, including Lakeland, is that, and again, having dialogue with other capital markets people, places are starting to pivot away from locking in a rate for 45, 60 days at the time of commitment to get to the closing table. We still have an element of that, we still do that. But I can tell you that it's more of a discussion point now about having rates float to close for 5-10 days prior to close at index plus spread, right? So that's another challenge. It's, what's going to happen in the next 45, 60 days, where again, before, for the past 10 years, we really haven't worried about that.
We have a lot of mortgage bankers and mortgage brokers in our audience this morning. I'm wondering if our lenders primarily can speak to how our mortgage bankers and mortgage brokers could be more responsive and more helpful to you in getting these deals across the finish line.
That's, if you don't mind, that's a great question. It's actually been an issue we're having. We're very broker oriented here. Our biggest issue right now, I think, is between accepted term sheet and enough information to get to underwriting. So, and I'm sorry, I call it purgatory on our reports, meaning that term sheets out, they've accepted, they've actually paid money for third parties, and now we're waiting for information. So the best thing the broker could do for us, besides, and Gary's right, manage expectations, especially from term sheet to underwriting, but actually get us the information we need so we can start working on it.
As Mike said, that's our biggest issue. There are certain brokerage firms and brokers who are extremely good at the gathering of the due diligence information, especially if they have a exclusive with the owner. You sort of shake out some of the brokers who are sort of being mercenaries who are trying to grab a deal, and you can't get any information. So you'll have a term sheet out and it'll just be is sitting in purgatory for a very extended period of time. I think the best thing is that the brokers assist us in getting these things through to underwriting. That just speeds up the process, and that's a huge help.
Yeah, and Ron, if they open up the communication line, they keep the communication line open to the correct borrower. So the bank is having direct communication with the borrower in conjunction with the broker. That's critically important, because if you kind of get things, communication lines held up in the middle, it delays the process, which, and again, you've been beating a dead horse about the fact that we're in a rising rate environment. You want to move quickly. And anything that the brokers can do to help us move more quickly is going to help their client.
Ron,
Yes.
from a legal
Randy.
side, I was gonna say, from a legal side, the broker can be, I find sometimes incredibly helpful. After the deal is committed, same issue you have before commitment. The brokers that get on the phone and put the calls together and get everybody to get the information that's needed that's one of the biggest helps. Because you send out lists, you need things, and before, whether it's committed or after, sometimes the list, they just sit. I find if the broker can get involved, I find things move quicker, or at least everybody knows what's needed out there. And a lot of times they have all the information.
Right, and also, as we know, time kills all deals. So the quicker we can, move it through, and a lot of our broker partners and everything have been crucial in, getting the borrowers to sort of, get off the pot and start, pushing paper our way. I hate to say it, we're still, we're a lot of due diligence has to be done on our deals, and they're crucial at making that happen. So, like I said, time kills all deals. So the quicker the deal and getting into underwriting and getting that rate that you want is crucial.
For us, Ron, it's give us the good, the bad, and the ugly. Don't try to hide it, because we're gonna find it in due diligence, and then my credit people are gonna be like, well, we didn't know about this, and then the deal's gonna die. So let us know what's going on. Give us a good story, and if we know it up front and we decide to move forward, we're gonna get through that. But if we find it during due diligence, it's dead.
Hey, Ken, I tell my students this, and then they say to me, what do you mean by ugly? So I want to let you know, ugly is really a reference point that's a lot of people don't quite get. Before I ask my next question, just for the lenders, I want the lenders to know that one of the comments that just came through the Q&A is we have a broker in the audience who has a $10 million construction loan, mixed use, in Philadelphia, wants to know if any of the four lenders on the panel is interested in pursuing that. I'll be happy to act as a medium. I won't be the broker for record, but I'll be happy to move it forward if any of the four lenders want to push that idea forward. You could just send me an email after the panel, and I'll get back to the individual from the audience who is sponsoring this particular transaction. All right, my next question is very simply, 3 years ago, when COVID hit and the world seemed to be coming to an end, everyone you spoke to said there is going to be a huge influx of defaulted loans and non-performing assets. And my question now, almost 3 years later, is what happened? We have these major real estate funds that grew with huge amounts of cash coming into their offices, waiting for the market to literally go down into the sewer. And apparently it never happened. So I have a two-pronged question. One, what happened in your estimation? And two, with respect to your banks, do you see within your own portfolio any major increase for non-performing and distressed assets. Any of the lenders could speak first, and then Randy, I'd love to hear what you have to say as well.
Sure, I can go. Yeah, quickly, I think what got us through was when we started underwriting, we did underwrite reserves up front to try to get us through the hard times. That helped. And Steve brought up the fact that we gave people forbearance. So which I think was the best thing a bank could have done. Now looking back at it, we only had one defaulted loan on the C&I side, a business, and we've had no losses from real estate. And I think what really happened, what helped is that, and again, as Steve mentioned, that the forbearance got them through the hard times, and then we just picked up. We tack it on to the end and we move forward. So you're right, Ron. We didn't have any issues.
Ron, sort of the same thing here, with echoing what Mike had said. We have been, pretty active at managing the portfolio. And I think that the forbearance that, sort of was placed on us, it made it very easy to just, push things off. And that gave everybody time to sort of reset. We have, some loans that have some issues here and there, but no lie, we probably have 100 to 150 plus firms that have huge capital that are looking to buy our transactions. And but there's a huge demand out there for product, but with the forbearance and sort of the backstop, the deals that you had in 2008 and earlier in those cycles where there was huge, people were paying 30 cents on the dollar. We're not seeing any of that. We're selling, if we got to a point where we're exiting out, we're selling at par on our deals, and even getting recoveries for past due interest and stuff. So there's such a deep pool of buyers that we're able to, if there is something that gets to that, we're able to get it back relatively easy and get our money out.
For us, we set up.
Sorry, go ahead.
Oh, that's okay. We set up a lot of interest reserves back then, and to get us through to this point. So our default rate is maybe one property at this point. So we did not have a problem.
Yeah, I mean, we, at year end, it was pre-first constitution. We're $8 billion in assets. And, I think we had, 25 million maybe in classified as non-performing. So very small number. So the credit file is held up, and I think that's you got to give a lot of credit to the credit partners and the lenders that are on the respective banks.
Yeah, I'll add to that too. I think also, a lot of the borrowers went into this crisis financially stable, right? This was not a financial crisis, it was a health crisis. So you had a lot of the potential borrowers, owners that were in pretty good financial shape going into it. So I think even leading up to it, we were in a good spot. So the negative impact compared to like 08 and 09, which was a financial crisis.
Ron,
Randy, from the legal point of view?
Well, it's not so much legal, but I also think what you have over the last 10 years coming out of basically what I call the crash or the recession is much more conservative lending. And so you didn't have overextended borrowers and loans that they weren't at a 95% debt service coverage ratio. They were at the normal debt service coverage ratio, so they could cover it. Coupled with my lenders, all of them they all did forbearance, and I think the PPP helped a lot of people also. So it's a combination of all three.
Okay, before we're running out of time here, let me ask our panelists if they have any last comments, thoughts, opinions on anything they want to express to our audience.
I think quickly, I would keep an eye on offshore capital coming into the US and bolstering some of the pricing on this as well. And we just had, I think a lot of our compatriots at JLL went out to that MIPIM conference in Europe, and the commentary seemed to be in terms of safety and potential growth, the US, and particularly the commercial real estate markets, presented a pretty decent opportunity today. So with the stock market, up and down, and I think the upside of what we're seeing in commercial real estate, I would keep an eye on more offshore capital coming in.
Yeah, and one of the things you have to be careful about is, the commercial real estate industry is a target for PSA issues, Bank Secrecy Act issues. So, you have to do an incredible job scrubbing where the source of funds is coming from.
Michael, Gary, any final comments?
No, I'm good. I guess one little quickie, the question regarding what brokers can also do to help, and I think Randi can actually speak better to it, is we're getting a lot of, I don't want to say convoluted because that's insulting. We're getting a lot of weird ownership structures. And a lot of times it's coming up after the term sheet, and then people can't understand why there are delays. So maybe if the brokers can help, if it's possible, to understand the ownership structure at inception of the deal.
Yeah, I'll echo that with Mike. We have several deals that have constantly changing ownership structure, even on existing deals, where they're literally putting themselves in default by changing the ownership structure during the time of our loan. So we have to constantly have them either unwind what they're doing or deal with it another way. So I think, for new deals, knowing what the actual ownership is and sort of having the owner sort of stand still for enough time to let us get it through underwriting and do that. If they want to do something prior to closing, okay, we can work that in. But we've had one deal. The last deal was like 3 times the ownership changed before we got to the closing, and I don't know, just try to stay on top of that. I mean, we're subject to so many audits and reviews, and everything from outside agencies, internal audit committees. So the due diligence process and all the information, all that paperwork that you send us does mean something, and it certainly is an assistance to make sure that we gather all that information up and make it easier for everyone.
Might increase the broker fee, Gary. Be careful.
To echo,
They earn their money, that's for sure. They definitely earn their money.
Ron, to echo Michael's comment, getting upfront, and Gary's, the structure of the transaction would go miles. It really would, because most today you see all these joint venture structures. You're not really sure who's the actual manager of it. You're not really sure who's putting the money in. You're not sure what the internal guarantees are within the structure. That it takes a lot of time to unravel it, and the time to unravel it would be when it's presented to the bank, not after it's been approved. That would be an incredible help.
Okay. Seems like we had the same concerns when I was lending back 15 years ago. Amazing. Things haven't changed that much. Okay. I want to thank our panelists for an excellent dialogue, an excellent presentation. Also want to thank our panelists once again for their participation and their sponsorship in this morning's program. With that, I will turn it back over to Leah.
Thank you, Ron. Same thing. I just want to thank all the panelists and the sponsors as well. Thank you to our silver sponsor, Spencer Savings Bank, our bronze sponsor, JLL, and our corporate sponsors, Kearny Bank, Verus, Saiber Attorneys at Law, and Lakeland Bank. Thank you to all the attendees as well for taking time for joining us today. It has been recorded, and it will be up on our website if you guys want to review it again. And if you have any questions for any of the panelists, Ron or myself, please just send me an email and we will answer them right away. Thank you guys so much, and I hope you guys have a great day.
Okay, thanks everybody.
Thank you.
Bye-bye.